Hi, I'm Ava. I'm here to share market insights, provide easy-to-understand tips, and help you make informed investment decisions. Let's get started. In this video, we're going to be talking about the Federal Reserve's FOMC meeting and what that means for the economy. Specifically, we'll be discussing interest rate decisions, peak interest rates, and how these changes might affect the economy, whether there might be a recession or not. So, the Federal Reserve recently raised interest rates by 0.25%, bringing the Fed funds rate to 5.0%. This is a pretty significant change, especially considering that not too long ago, interest rates were only 0 to 0.25%. The reason behind this spike in interest rates is to combat inflation. By increasing interest rates, the Federal Reserve hopes to slow down the economy, which will then reduce demand, bringing down inflation with it. The Federal Reserve has also updated its economic projections and now expects peak interest rates to be at 5.25%. When Jerome Powell testified before Congress, the market was expecting a 0.5% interest rate increase, but this changed after some recent banking collapses. Because of these collapses, the market no longer believes that the Federal Reserve will raise interest rates to 5.75%. This change in interest rates affects the banking sector significantly. Banks had gotten used to a 0% interest rate environment, where money was cheap and easy to come by. However, they can no longer get away with paying 0% interest to retain customer deposits. Customers can easily take their money out and earn interest elsewhere. Additionally, borrowing money has become much more expensive for banks, which means that the cost of capital has gone up dramatically. So, what does all of this mean for the economy? We won't have official data until April 27th, but the expectation is that GDP will slow down. We don't know if it will go negative this quarter or in the future, but opinions are all over the place. Some people believe there will be a soft landing, while others think there might be a crash landing, and some think there won't be any landing at all. What we do know is that rising interest rates will cause damage to the economy. This damage is interconnected with unemployment rates. The Federal Reserve is concerned about the tight labor market, as it is contributing to wage inflation. However, with the higher interest rate environment, the expectation is that unemployment will rise. We already saw an uptick in unemployment rates in February. So, there you have it, a brief overview of what's been going on with the Federal Reserve and how that might affect the economy. We'll have to wait and see how everything plays out in the coming months. But for now, it's a bit of a waiting game. If you find value in the content I'm sharing, please consider subscribing to our channel and giving this video a like. Your support helps us continue to create informative and helpful videos for our viewers. Thank you.